$15,000. That's the number I want you to focus on for the next 11 minutes. If you have $15,000 sitting in cash right now or in traditional stock index funds, what I'm about to tell you could be the difference between preserving your wealth and watching 30 to 40% of it evaporate by the end of 2027. I'm Dalio. I've managed money for 45 years. My firm, Bridgewater Associates, manages $124 billion. I've navigated the 1987 crash, the 2000 dot-com bust, the 2008 financial crisis, and the 2020 pandemic. I predicted the '08 collapse 18 months before it happened. Today, I'm going to show you exactly which two assets I'm moving money into right now, why I'm selling $15,000 of traditional equities to do it, and the specific 60-day window you have to reposition before the next phase of this debt cycle accelerates. Let's get into it. Before I explain the trade, you need to understand why I see what most investors miss. In 1982, I lost everything. I had built Bridgewater through the 70s, made some bold calls on Latin American debt, and I was convinced Mexico was going to default. I was right about the default. I was catastrophically wrong about what would happen next. I thought the economy would collapse. Instead, the Fed flooded the system with liquidity. The stock market soared. I had to let every employee go. I borrowed $4,000 from my father to cover family expenses. I was 43 years old, starting over. That failure taught me the most important lesson of my career. Being right about one variable means nothing if you don't understand the machine. The economy is a machine. It has gears: credit expansion, productivity growth, debt accumulation, deleveraging, money printing. These gears turn in predictable sequences. I spent the next decade studying 500 years of economic history, every empire, every reserve currency, every debt crisis. I built a framework I call the Big Debt Cycle. It has 8 distinct stages. We are currently in Stage 7. Stage 8 is the restructuring, the reset. And if you don't understand which assets survive the transition from Stage 7 to Stage 8, you will be wiped out. Here's what most people miss. They think the stock market reflects the economy. It doesn't. The stock market reflects liquidity and sentiment. Right now, we have record liquidity from 15 years of money printing colliding with late-stage debt dynamics. The gap between asset prices and economic fundamentals has never been wider. Not in 2000, not in 2007, never. When I look at the current environment, I see 3 things. Unfunded liabilities in the United States alone exceeding $200 trillion. A federal debt growing at $2 trillion per year with no political will to stop it. And a global reserve currency, the dollar, that every major creditor nation is actively trying to diversify away from. This is not a prediction. This is math. Let me walk you through the 5-factor framework I use to assess systemic risk. I check these 5 indicators every single quarter. When 3 of the 5 flash red, I reduce equity exposure. When 4 flash red, I move aggressively into safe havens. Right now, all 5 are red. Factor 1. Debt to GDP. The United States federal debt is now 123% of GDP. The threshold for debt crises historically is 90%. We blew past that in 2012. Factor 2. Deficit spending as a percentage of GDP. We're running deficits of 6 to 7% in a supposedly strong economy. In the 1930s and 1970s, deficits this large only appeared during wars or depressions. Factor 3. Unfunded liabilities. Social Security, Medicare, federal pensions. These are promises the government has made that have no funding mechanism. The present value of these obligations is $212 trillion. That's 6 times our total national net worth. Factor 4. Interest expense. We now spend more on interest on the national debt than we do on defense. Within 18 months, interest will be the single largest line item in the federal budget. Factor 5. Foreign ownership of treasuries. China, Japan, and Saudi Arabia have been net sellers of U.S. Treasuries for 3 consecutive years. When your creditors stop buying your debt, you enter the end game. Now, here's the part no one is talking about. The Fed has 2 choices. Choice 1, let interest rates rise to wherever the market demands, which would immediately blow out the deficit, collapse the housing market, and trigger a wave of corporate defaults. Choice 2, cap rates by printing money to buy treasuries themselves. That's yield curve control. Japan did this. It leads directly to currency devaluation. The Fed will choose option 2. They have to, which means the dollar will weaken, inflation will stay elevated, and cash will be the worst place to hide. I want you to imagine 2 investors. Let's call them Sarah and David. Both are 52 years old. Both have $400,000 saved. In January of 2026, Sarah reads the signals. She takes $15,000 out of her S&P 500 index fund and reallocates it into the 2 assets I'm about to describe. David does nothing. He thinks I'm being alarmist. He stays in cash and index funds. By December of 2027, the dollar has weakened 12% against a basket of hard currencies. Inflation has stayed at 4 to 5%. The S&P is flat to down because real earnings are compressing. Sarah's $15,000 reallocation is now worth $22,000. David's portfolio has lost 8% in real purchasing power. Sarah didn't get lucky, she understood the machine. So what are the 2 assets? Gold and inflation-protected bonds, specifically physical gold or gold ETFs, and Treasury inflation-protected securities, TIPS. Let me explain exactly why and exactly how to deploy $15,000. Asset 1, gold. Gold is the only asset in human history that has maintained purchasing power across every debt cycle, every currency collapse, every regime change. I don't hold gold because I think it's going to the moon. I hold gold because it's the only financial asset with no counterparty risk. It's not someone else's liability. When governments print money, gold reprices higher in that currency. It's automatic. Right now, central banks around the world are buying gold at the fastest pace since 1950. China added 225 tons in the last 18 months. Russia, India, Turkey, all accumulating. They're not doing this for fun. They're preparing for a world where the dollar is no longer the sole reserve currency. Here's the allocation. Take $7,500 of your $15,000 and put it in gold. If you want simplicity, buy the GLD ETF. If you want actual physical metal, buy 1-ounce American Gold Eagles or Canadian Maple Leafs from a reputable dealer like APEMS or SD Bullion. Store it in a safe or a safety deposit box, not in your house if you live in a high crime area. The key is you want this outside the banking system. If we enter a period of bank bail-ins or capital controls, which happened in Cyprus in 2013 and Greece in 2015, physical gold is untouchable. Asset 2, TIPS, Treasury inflation-protected securities. These are bonds issued by the U.S. government where the principal adjusts with the Consumer Price Index. If inflation runs at 4%, your principal grows by 4%. When the bond matures, you get the adjusted principal plus interest. Right now, you can buy TIPS with real yields around 2%. That means if inflation is 4%, your total return is 6%, and it's government guaranteed. Compare that to a savings account paying 4.5% nominal, with inflation eating 4%. You're earning 0.5% real. TIPS give you 2% real, and they go up if inflation accelerates. Take the remaining $7,500 and buy TIPS. You can do this directly through treasurydirect.gov, or you can buy the ETF, ticker symbol CHPR or TIP. I prefer the ETF for liquidity. The Schwab U.S. TIPS ETF, CHPR, has a low expense ratio and tight tracking. Buy it in your brokerage account. Hold it for a minimum of 18 months. If inflation stays elevated, you're protected. If inflation spikes, you outperform everything except gold. Now, let me be very specific about timing.
I want you to make this reallocation within the next 60 days. Why 60 days? Because we're entering the back half of 2026 and the fiscal situation is accelerating. The Treasury has to refinance $4.8 trillion of debt in the next 12 months. Every time they roll that debt, they're paying higher interest. The Congressional Budget Office just projected that by 2028, interest on the debt will exceed all discretionary spending combined. When that happens, the Fed will be forced to intervene. Yield curve control is coming. When it's announced, gold will gap up 10 to 15% in a week. You won't have time to get positioned. You need to move now. Let me bring this back to the $15,000. This is not about getting rich. This is about not getting poor. The wealth transfer that's coming in the next 3 years will be the largest in modern history. It will move from people who hold depreciating paper assets to people who hold